From an accounting perspective, there is so much that has happened in the property market where people are now starting to sell their properties in particular markets because they've made X amount of capital growth. But that has ongoing tax ramifications for it, which is pretty boring. But it means money. This week, we have Jeremy Iannuzzelli from Comparative Partners breaking down all of the tax stuff. So taxes, guys, we're in May. June 30th is when we need to get all this stuff sorted. There is some situations in this podcast or in this live session where Jeremy breaks down how you can save tens of thousands of dollars, but you have to do it before June 30. So stay tuned for that. But what we're going to be covering off for him is not boring tax stuff. I hate tax conversations. And then I pick up the phone to Jeremy. I'm like, mate, you just broke that down so simply. This isn't easy to understand. In this session, we're going to talk about why investors should consider selling. What are the situations in which you should pick up when you shouldn't as well. Also, we're going to be kind of how do you navigate the tax season, what things you should be doing, what things you shouldn't be doing, and also just a whole heap of stuff around tax that wasn't boring. This is one of these sessions where it gets to an hour and a half. I'm like, damn, I feel like we've only just scratched the surface of this stuff. But anyway, my name's Joe Tucker, and with Jeff Miles, we created Oz Property Investors and the Level Up Property course. Each week, we interview top property experts and we unpack their wisdom, their lessons, so that we don't make any mistakes in our property investing journey. And this week is no different. Jeremy Iannuzzelli is an absolute weapon in the property tax space. If you don't know him, check him out. Let's jump in.
Some of the reasons that investors you're seeing are selling at the moment? Is that legislation change or the fear of? Is that the reason why some people are selling? Or like what are some of the other reasons why people are taking money off the table maybe?
Yeah, so one of the main, I always like to ask the question, what's the motivation for selling? Because I don't want to encourage anybody to sell or keep a property. And I want to make sure that you're asking yourself all the right questions. And the main things I'm hearing at the moment from people is that, look, the property's quite old. It's done extremely well. It's maybe doubled in the space of 4 to 5 years. We may have owned it for 10. Property's very old. We know it needs new gutters. It needs new roof. It needs a lot of maintenance to the building, which doesn't necessarily increase value. Now, Joe, I'm not sure on your end, but when you're, conducting your buyer's agency service, are you necessarily saying that I'm willing to pay 10 grand extra for this client to buy this property because it's got a new roof?
To say I'll pay 10 grand more for a new roof.
Yeah,
that's got a new roof.
I mean, yeah, it's one of those things that you really want to get, but we will get a discount if there is a buggered roof for sure. Like
Absolutely.
If we go up and do the pets and building and it's destroyed, or there's little holes and things like that, and you can just replace a couple of sheets, but we'll always push back and renegotiate. But when it has a redone roof, they never get much. Like it'll cost $30,000 to redo a roof, and we might, we'll buy it at market price, and then like they don't make that 20 grand or 30 grand because they got a new roof.
That's it. So that's probably been absolutely. That's what I'm getting at. If you've got two houses side by side, both carbon copy identical, one's got a new roof and one doesn't, you're not necessarily going to pay 10, 15 grand extra for the one with a new roof. So a lot of people have, bought into these older areas and, may need a lot of not just cosmetic, but a lot of genuine building and foundation work. And they're just not seeing the value in doing it. And, they've made their money, and that's an opportunity for them to say, well, we'll now sell and we'll pass that project on to somebody else who may see value that we don't, or have the time that we don't have. So that's one of the main things. A lot of the clients' properties I'm seeing that they're selling are very old, very run down, and they just simply don't have the capital to be able to spend that 30, 40, 50 grand on bringing it back up to scratch, where it's not going to add necessarily more value. So to me, I look at that as sometimes a smart decision, because you're spending money, not necessarily going to get that in return. Second reason, I'm starting to see people shift in terms of a dynamic. We all spoke about years ago this mortgage cliff that was going to happen, that we can all probably say now that really didn't happen. But what has happened, and I get to see it because I'm very close and I get intimate with a lot of people's inner workings of how they take care of their finances, is that a lot of buffers have reduced. There's no doubt about it. A lot of people's buffers and cash savings that they had during COVID because they weren't spending money have now been diminished. Not diminished to zero, but diminished to enough to say that, hey, we don't have the capital moving forward to cover that new roof if it comes. So they're wanting to replenish a bit of their buffer. They're wanting to build up their offset account on their own home again, or maybe wanting to reduce debt. Because what higher interest rates does do is it does change the mentality. As we had a mentality that rates were low and rates were going to stay low and property was going to move at 25% per annum religiously for the next 10 years, that was very quickly changed in the history books when rates went up to, banking rates of 7 or 6.5%. And that forced people to now really look at the numbers more carefully, make sure they're managing their finances, and more importantly, that the roller coaster of roses and sunshine and rainbows doesn't always last forever. And I think that's been a really good reset for a lot of property investors, that when there's good times, you take advantage of it. And you've also got to make sure you put in away for those tougher times to come. So starting to see savings diminish on that back end.
You've alluded to some of the questions or considerations people should be asking themselves before they sell. If we could get you to rattle off those, so people could write them down or just think about them, because for me, that's you've talked about them. So I'd love you to sort of unpack what those questions people should be asking themselves before they sell.
So I always say the first thing I think about is, if I'm selling, where am I going to put the money? Where am I going to get a better arbitrage? At the moment, I'm getting a return of X. I need to be selling to get a return of Y, and Y must be greater than X, because it never makes sense to sell something to put it into something else that's going down in value or losing money. So number one, that's one of the first things.
No
number
NFT.
two, no, definitely no NFTs. NTFs or NFTs? I don't even know. I can't even catch up with all these abbreviations of Bitcoin and stuff like that. But so that number one, if I got somewhere else to put it and put it in a stronger market or a stronger asset. Number two, what stage I am in my life. Am I focusing on my balance sheet, which is my accumulation and wanting to continue to grow my assets, or am I focusing on maybe looking to generate more cash flow? So that needs to make sense for you as well. Then you really need to look at the asset itself as how it can improve the value. And if the money I'm going to spend is generally going to improve it, or is it actually just going to help it sell, or is it going to do nothing at all? Because if you've got $100,000 you need to spend to underpin the property, it might be worthwhile to not spend that money because you're not going to get anywhere near the money back. It might help you to sell it, but it may not be profitable for you as an exercise. Then the last couple considerations are there tax considerations as to why I need to sell it or what benefits I can obtain from it? So that's more important. And the last thing is I always want to assess the borrowing capacity. Do I need to sell it? So yes, it may go through all those various different things, but do I actually need to sell it? And sometimes if you don't need to sell something, don't do it. Just extract the equity out, use that tax-free equity then to maybe then to buy another property. For me, when I'm selling something, there's a reason behind it. It's stopping me from moving forward and doing something else. Where if the bank just continued to give me money and never stop me from borrowing, Jeff and Joe, I'd keep every single thing I've ever bought. Self-managed super fund is one of those really transactional entities, and it's an entity which forces you to sell. Because as we all know, in super, you can't extract equity from a property in super that has grown in value, because limited recourse borrowing arrangements restrict you from doing that. Essentially, they're wanting you to become quite vanilla and not taking too much risk. So when you're in super, to realize that gain, to realize that equity, it actually forces you to sell. And that's a strategy where now you create your capital back plus profit to then use that to go buy two. So again, I'll say with my strategy, if I can keep everything, I always would. But what I'm having to sell, I will sell. And the goal is not to replace it like for like, because that's when we lose money because of the transaction costs involved. My goal is to put that money and that profit into a far better performing asset or assets. And that's getting me where I need to be a lot quicker. So you can be strategic around how you do it. And in the end, we want a portfolio that's going to provide for our future and our future needs, which could be cash flow. And I am starting to see more sophisticated investors who have really strong incomes, not caring about cash flow, which is fine, and just working on the back of, Jeremy, I'm going to be selling my properties as a stage sale when I get to my 50s and 60s, and that's what I'm going to live off. So I'm not concerned about rental revenue or the golden goose that keeps giving income. I'm more concerned about building up capital, because that's where that denominator can really accelerate. And then I'll have a sell down approach, and that's how I'm going to fund my lifestyle.
Yeah, that's a masterclass. But where are you sort of seeing that people are sort of selling those? It's probably number one, Perth. Maybe it's not Perth. I don't know. Where are people selling those deals you see, whether it be for whatever reason? Is it Perth, Adelaide, Brisbane, maybe, or are we Sydney?
But believe it or not, from my client base, I'm actually probably seeing more people sell in that southeast region of Queensland as a volume basis, openly as a volume basis. Yep. And that's because, again, they've owned these properties for a number of years. They're starting to get quite old. And they're not selling because they don't think the area is terrible or not going to grow. They're just selling because it's actually becoming a money pit for them. So those lower socioeconomic areas, that's where I'm seeing a bit more movement of late. Yes, there's areas of Perth that people are cashing in on and moving into, far north Queensland. Some people moving into Northern Territory. Some people moving into Victoria. Northern Adelaide, so those places like Elizabeth Hills and Salisbury, anyone who's brand new to investing, who saw those prices and who bought there without looking at it, had a rude shock after about 2 or 3 years. 2 shocks. Number one, they saw their values increase substantially, so that's positive. That's a good shock.
And the rents maybe.
And the rents went up, and the second shot is the tenant quality. So they've started to really feel that, oh, wow, these guys, yes, some of them are paying a rent, but they're not paying on time, or some people don't pay rent at all. So some of those areas, those lower socioeconomic areas where lower price points, they're saying, I've made my money, but I just don't want to deal with the headache anymore. I haven't seen any movements, although far north Queensland did get a huge amount of investor activity over the last 1.5 years. I haven't really started to see any selling happen there. If anything, I'm still seeing some really good buy movements into there. Still a lot more people buying, and property professionals buying in there. And yes, Victoria's getting the property professionals, but I'd probably say I think there's more activity, and this is talking to people I know on the ground in Victoria. I know, Joe, you did a video not long ago about how you took all your staff there, but in Victoria, believe it or not, the buyer activity is not coming from investors yet. It's coming from first home buyers.
Yeah. Because they've got those incentives, you reckon, or is it just too expensive to rent, or what do you see the reason?
Just the price point. It's been a very suppressed priced market for such a long time, and seen it with my own eyes. A lot of the people lining up that are looking to go buy homes in a lot of these, home friendly, PPOR friendly areas are first home buyers.
Trusts in 2025, or midway through 25, they were I'm seeing less and less. I mean, maybe I'm just not watching enough content, but is there less of a buzzword around trusts midway through 2025? Has the sheen worn off it, or is it you still seeing the ability to grow portfolios using trusts midway through this year? What are you seeing?
Definitely there needs to be a genuine understanding and circumstance of doing a trust compared to what it was, say, 2 or 3 years ago. Again, it's a long-term entity, and you've got to look at the long-term benefits that it provides. And as interest rates come down, you'll start to see a lot more properties move from being well negative to maybe slightly negative to maybe even neutral or positive. So there is still a long-term benefit. But I think the way you use a trust now needs to be more sophisticated than what it was when people were going out and buying $1 million property, renting for $1,000 a week at 2% interest rates, where they were getting $52,000 a year in rent, paying $22,000 a year roughly in interest, $10,000 in costs. It was crazy to see that when you bought a property under 100% leverage, you made $20,000 to $30,000 profit. Just never made sense. Just blew my mind that that's what people could achieve. Obviously now, with interest rates higher and have been high for longer, you need to be more strategic. You need to treat the sophisticated entity for what it is and buy sophisticated properties with a sophisticated strategy. So I talk to people about a path to being positive. I talk to people about what's your business plan for that property. And if you're buying just a stock standard 3-bedroom home that has 10 years of potential negative gearing as a forecast, then it might be worthwhile to take that bird in your hand as opposed to doing the bush and get the negative gearing benefits, because it's going to help you hold the property longer term. Yes, there is tax at the tail with capital gain tax, but it is what it is. But if you're buying strategically, looking at the right type of properties to have a good path to being positive, there's a lot of benefits that you get from a trust, not today, but in the years to come. And a lot of my portfolio is able to be continued to be built because of the properties that I purchased in trust all those years ago. A couple other things I'm hearing, and not sophisticated tax strategy, but more sophisticated lending, is that a lot of brokers are starting to do this for their clients, where some of their clients have tapped out from a lending perspective. They're able to do self-declaration letters with a specific bank, which I won't name, to say
talking about that. I didn't think that was creative. I didn't think we talked about the creative lending, but
yeah, I won't talk about what bank it is, and I won't throw any. But there is some things happening where people are doing self-declaration letters to say that their trust is positive, so it's not done by an accountant, and it's able to give them an extra property that otherwise they couldn't have been able to borrow for. So there is some of that happening, and it only is available to people that may have properties in trust already and are looking to buy future properties in trust as well. So without a doubt, structure is there for sophisticated investors. It's not there for people, in my opinion, on your first or second or sometimes even third property. But if you've already got a well-established portfolio and you've got the means, which is a great business or a great job or a really good cash cow behind you to help continue to fund deals, you'll find that structure long term is going to be one of the best things that you enter into. But it's where you are in your journey and your availability to use all the benefits around it. So has it lost its luster a bit, Jeff? Absolutely. Is it still an
much
entity?
Content. That's all it tells me. I'm not on TikTok, but I imagine
it's absolutely lost its luster, and it's not there for everybody as it once was. But for the right people that are wanting to take that sophisticated approach, without a doubt, it's a great entity for the future. I'll leave people with a couple other things for tax side of things. So number one, make sure that any costs that you need to be spending prior to 30 June 2025, you do it. So if you've got, a couple of those little minor repairs and maintenance, or there's a couple of bills like insurance is one of the big things. If you've got an insurance bill before 30 June and it's due 6th of July, pay the damn thing before 30 June. If you've got some expenses like council rates, a quarterly notice that you've received, which is due 6th of July, pay the damn thing in 30 June. That way will ensure that you get your money back as a refund earlier than having to wait till the next financial year. So timing of expenses is important. The ATO are hunting down and now getting sent all the data from the banks. So anyone who's got a mortgage, a loan, you are now getting your loan details, loan interest getting sent to the ATO, and the ATO are data matching from that. So if you've used your equity to go buy a car or a boat, you will get found out, because they're looking at your starting and ending loan balances. They're looking at the way you're obtaining the loans, and they're data matching that against their systems. So make sure that if you've used equity from property A to purchase property B, ensure that you're claiming that interest on that equity in property B, because that is where the purpose of the loan was for. That was the purpose of the loan. Making sure you're claiming all of your interest accordingly. One of the big things, and it's happening quite a bit as a lot of people are refinancing, if you have paid LMI with CBA, for argument's sake, when you first bought the property, and normally lender's mortgage insurance is a borrowing cost claimed over 5 years, and you may have refinanced that loan with NAB 2 years later, the remaining balance of the lender's mortgage insurance left over when you paid it with CBA can be claimed up front. So if you paid $5,000 with CBA and only claimed $2,000 so far, you've got $3,000 remaining, and you've now went and spent more LMI with NAB on a refinance. That remaining $3,000 LMI with CBA can be claimed up front, and the new LMI with NAB is now claimed over 5 years. So that is something you need to make sure you're advising your accountants of. If you have had a refinance during the year, ensure any remaining balance of your borrowing costs are claimed up front. Depreciation schedules, make sure you get them. You've got the costs that you can claim on the depreciation schedule. If you pay it before 30 June, that's going to help with tax, and it'll make sure that'll maximize your refund. Scrapping reports, again, if you've had any items that you've had to scrap, it could have been an air conditioner that you purchased 3 years ago and it's now been thrown away because the damn thing broke down and warranty didn't fix it and you have to go spend money on a new one. Make sure you claim the closing written down value, which is the amount of depreciation on that air conditioner that you haven't claimed thus far. So it's called a scrapping depreciation. So there are a couple little things that you can do to improve your situation. Couple other things, you've got PYG variations that you may need to do moving forward on 1st of July. So if you're needing a little bit of help from a cash flow perspective, rather than waiting till the end of the year to get a big refund, speak to your accountant, get your PYG variation in on the 1st of July, estimate what potentially your refund will be, and that's going to help you improve your cash flow to hold your properties. You don't have to wait till the end of the financial year to get your big refund. In fact, smart people, and what a lot of smart people are doing, is they're getting their PYG variations in early if they know they're going to get very large refunds, and they're now getting the benefit of utilizing that money from tax earlier to maybe go in their offset accounts or to help them hold their portfolio longer, or to even save and be that little bit of extra cash that they then use to buy their next property. So there are a couple little things that you guys can do now to get some immediate wins and benefits. There's a plethora of other things. Don't be dodgy. Tax office are going to be hunting you. Their systems have been upgraded like you wouldn't believe. The amount of money they're pumping into catching and auditing people is huge. I've had a couple of reviews from my clients where they're doing data matching reviews. We keep all the substantiation and we've been able to pass that with flying colours. But from what I am seeing, they are going as deep down as to say, well, who actually owns the property? Is it really 50-50 or did you do 95-5? So just make sure you are getting really a good understanding of your own portfolio so you can pass that information over. Last thing, if you have sold a property in the 2025 financial year, I said at the start, I'll repeat it again, you've only got a very small window to utilize your carried forward concessional contributions, which is your 5-year rule in super, to get that money in your super to obtain a substantial tax benefit. So if you're wanting to save tax and wanting to utilize super to do it, you need to do it now. It needs to hit the super fund bank account before 30 June, or else it won't be utilized or be able to be claimed as a deduction. So there's some little things you can do to really improve your position and get a far better return and make a little bit of extra money.